Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. It's another day of gains. Stock and crypto continue to rise after a sharp sell-off to start the month of December, and the clock is ticking toward the Fed's December meeting. We've got the top takeaways from the trading day. Plus, we're watching what's moving in after-hours trading. It's another busy day for earnings, and we have the trending tickers you need to watch. Plus, could a healthier housing market be on the way? We get Realtor.com's 2026 real estate outlook next. Well, the housing market has been in a sluggish state for 2025. Prospective home buyers still facing elevated mortgage rates and affordability being a major challenge for many households. But things may be turning up a little in the new year. Realtor.com senior economist Joel Berner joining us now to discuss. Joel, it is good to see you. So let's get right into this report, Joel. So mortgage rates, you say here, expected to stay above 6% in 2026. Your forecast, Joel, if I have this right, is 6.3% average mortgage rates next year. Let's start there, Joel. Why do they stay above 6%, Joel? And what does that mean for affordability next year?
Really, we see 2026 as a year of steadying across a lot of dimensions of the housing market. Mortgage rates are one piece of that. We expect the Federal Reserve's cuts in December to already be priced into the market, and we expect stability going forward with how monetary policy is handled and how the housing market responds. And so I think this mortgage rate stability is really welcome news for folks who have been on the sidelines for the last couple of years, unsure of whether they can get into the market or not because of how volatile rates have been. So we expect 6.3% average throughout 2026 and ending the year at 6.3%.
And affordability, it improves, Joel, you think, so I have this right, because you think incomes will rise faster than prices?
That's right. We project prices of homes to rise at about 2.2% over 2026, which we think is going to be a little bit below inflation and a little bit below income. So real and adjusted price of homes will actually improve a little bit in 2026. And the improvements in mortgage rates from this year's average, which is about 6.6%, play a part in there as well.
Home sales, you point out here, Joel, they hit a 30-year low in 2024. You think they improved slightly this year per your forecast. What happens in 2026, Joel?
2026, we're projecting a 1.7% increase in home sales, getting up into the 4.1 million range. Still pretty subdued from what a couple years ago were, but not down to the 30-year lows that we've been seeing in 2024 and 2025. So really, it's a little bit more of the same, just slightly steadying and a modest improvement in home sales volume.
What about inventory, Joel? I'm curious what you forecast next year. Are buyers going to have more options?
Buyers will have more options. Across the country, we project an 8.9% increase in the number of homes for sale. And this, of course, isn't uniform across the country. In different pockets, in different markets, we'll see inventory rising and falling at different rates. But overall, more options for buyers to choose from, less competition, so more negotiating power for buyers.
You point out, Joel, I mean, there are regional differences. Are there certain regions of the country, Joel, you all expect to outperform next year?
A lot of our strongest markets are in the Northeast and Midwest in terms of projections for 2026. You know, these are places where we expect sales volume to grow and prices to grow because inventory is more constrained. While in the South and West, inventory recovery has been a lot stronger. There's more new construction activity, and so more competition among sellers will keep prices a little bit more affordable and attainable, while in the Northeast and Midwest, we expect more growth.
You know, so some improvement next year, but what are the factors, Joel, the biggest factors that you think would be holding the housing market back? I mean, would it be, you know, is it rates? Is it prices, the economy? Walk me through it.
Rates and prices are for sure to blame in terms of what's holding the housing market back this year. But really, I think uncertainty surrounding the economy in general is really holding people on the sidelines. You know, people who are worried about their jobs are not looking to make giant purchases like a new home. And so I think anything that can be done to assuage those fears and build up consumer confidence will really go a long way in boosting the housing market in 2026.
A question for those who rent, Joel, and maybe watching this. You say rents expected to decline slightly by 1% next year. You say, A question that's sort of astral is renting more financially attractive than buying? You'll hear that put out there. That's a discussion point. As an economist, how do you try and think through that? What are the variables?
The most important things to think about are the time horizon and whether you consider being able to live in your investment valuable or not. Based on our price projections, that putting money into the S&P and renting might be a good way to get returns on your investment, but getting your foot in the door for home ownership is important for renters too. It's been especially difficult for first-time home buyers in recent years with mortgage rates remaining high. Those who don't have equity from an existing home have to save up what they can from their paychecks to make a down payment on their very first home, and that's been a challenge. So I certainly don't blame anyone who decides that renting is the right thing for them right now, but this should be another year of rent declines and a good time to save up for a down payment in the future if that's what your goals are.
Finally, Joe, just talk to me about the role the Fed plays here. The expectation is, the cuts continue. How does that play into your forecast?
Right. Our forecast is mostly built on economic inputs like GDP for the various locales that we look at in terms of employment, because the labor market always underpins the housing market. But the Federal Reserve is something that we keep an eye on, how they're behaving and what we expect out of them. Like we said a little bit earlier on the show, that the December rate cut is pretty well priced in already. But we're interested to see what the chairman and the FOMC has to say about the longer term projections for rate cuts and whether those will give mortgage rates room to even get below our projections. We're in the business of selling homes, so we'd love to see those rates come down.
Joe, good to have you on the show. Thank you, sir.
Thank you for having me, Josh.
Stick around. Much more Ask for a Trend still to come. We're wrapping up 2025 talking about Spotify. That stock has been on a tear this year, leaning into AI and a marketing power of its annual Wrapped feature. For more, we're bringing in Yahoo Finance senior reporter Allie Canal. Allie.
Now, Josh, I know you're not a Spotify guy. You're Apple Music.
That's correct.
We'll dig into the Wrapped in a little bit, but you were just talking about the strength of Spotify shares. The stock is up more than 20% since the start of the year. I will say we're significantly off the highs that we saw earlier this year. We have shares trading around $556, but earlier this year we saw as high as $775. So a bit of choppy trade there, still outperforming the S&P 500. And this comes as investors are really focusing in on price hikes, a leaner cost structure, and AI product innovation. Earnings have really reinforced a lot of that momentum with beats across revenue, profit, user growth. Margins also remain a highlight, and this was a big sticking point for investors in 2021, 2022. Then we saw that huge margin expansion throughout the course of last year. And then as recently as the third quarter, we saw margins hit 31.6%. Margins are expected to rise even higher for the current quarter. Expectations are set at around 32.9%. In the midst of that, we have leadership shifting. Daniel Ek, longtime CEO, he's going to be moving to an executive chairman role. And then Gustav Soderstrom and Alex Nordstrom, they're stepping into the co-CEO roles. And Wall Street largely viewing this as a continuation of the status quo rather than significant change. And the backdrop, that all sets us up for Spotify Wrap Day, which is today. So happy Spotify Wrap Day to all who celebrate. And this is that personalized breakdown of your favorite artists, songs, albums, your listening times. And it's really become this cultural phenomenon. And I personally like viewing my Spotify Wrapped. It really drives home how chaotic my listening trends are. As you can see, my listening,
Allie.
very eclectic.
It's eclectic.
I'm 64 years old according to the music I listen to.
What is that based on?
It's based on the fact that I listen to 70s. I have some Jackson 5 in there. I like, The Squeeze, Bread, a lot of those songs sneak into my top tracks. So that contributes to the listening age. I have a friend who they say she's 17 years old because she listens to all new songs. So that's sort of the name of the game here. A lot of AI, although it's interesting because my top artist is Madison Beer. I don't think many 64-year-olds are listening to Madison Beer. And I asked you if you knew who she was. And
no clue. Why? can I ask you, why is this such a big event? Great for Spotify, like a marketing gift, but what is the deal? Why does it resonate so much?
I think it's this aspect of community. It all sort of points to, what did you listen to? What did I listen to? How is it different? What does this say about my personality, your personality? There's actually a new feature called Wrapped Party this year, which is an interactive game that lets you compare stats with friends. You can compete on who discovered the most music. If there was any one specific song that you listened to, it even gives you specific days. Like one day it said I was jamming out to all these songs, and it was when I was skiing out in Utah. So it reminds me of all the good memories throughout the year. I mean, I love music.
Are there copycats of this? Like, do others try to mimic it?
Yeah, Apple and some of those other competitors,
successful?
YouTube, they have their own types of raps, but it's not as significant.
What are they missing, do you think?
I just think, one, you have the first mover advantage. Two, you have the fact that you have a lot of folks on Spotify, and Spotify releases the global figures as well. So when it comes to the most streamed artists, that's Bad Bunny. Top global song, Lady Gaga and Bruno Mars's Die With a Smile. Top podcast, The Joe Rogan Experience. And last year, the hashtag Spotify Wrapped pulled nearly 74 billion views on TikTok. And you also get little personalized messages from your favorite artists.
They do it
if
all.
you're in the top percent. I'm a big Spotify fan, and again, it's just nice to go down memory lane, view your chaotic viewing.
It's an event.
It's an event. It's an event.
Amazing.
We're gonna have to get you on Spotify because I'm curious.
Yeah.
Curious, Josh.
Yeah.
What you listen to.
Yeah, I'm curious to see what the age is. Scary.
It might be younger than me. Who knows?
Scary. All right, thank you, Allie. Appreciate it.
Of course.
Stick around. Much more as for a trend still to come. The Trump administration is investing up to $150 million in chip startup Xlight. The company's executive chairman, Pat Gelsinger, former Intel CEO, he joined Market Catalyst to discuss the U.S. investment, the outlook for AI, and more.
We're excited. Clearly this administration was motivated to move quickly. And with that, I'm thrilled with their sense of urgency in this area. The discussions with the CHIPS office have been going on for a couple of years. Obviously, as I stepped into this role, getting very active with the new leadership that came into place. And, there's been intense discussions over the last several months on the topic. And obviously, this week's announcement was quite the thrill to have this be the first announcement coming out of the new CHIPS office. So, for that, we see them as acting with urgency, picking technologies like Xlight that matter in a very significant way and leaning in the big way. They'll become a minority shareholder. Playground, our venture capital firm is the largest, but partnering with them to really, I'll say, rejuvenate on American soil for advanced semiconductor manufacturing. This is a great day.
Pat, you were the CHIPS guy. I think I talked to you pretty much every time you came back from a trip championing that bill or that act. What is the difference you see between this administration in terms of chip manufacturing in this country compared to the prior administration?
I see two things. One is the sense of urgency. I've been critical that the last administration took much too long, to get funds dispensed. We're competing with the world, and that sense of urgency. And second is they're using the full range of tools available to the government, to make this occur. And that's trade policy, that's tariffs, as well as incentives, research. We need to have an all play to fully realize our objectives with reshoring and rebuilding the U.S. semiconductor manufacturing industry. This is a great step.
In terms of the broader tech landscape now, Pat, you've been at the highest rung of corporate America, Intel. I think back to where you were also leading VMware. Our week started here at Yahoo Finance seeing a code red alert from Sam Altman and OpenAI. From your CEO, vantage point, would you ever issue something like that? And what does something like that signal to you about the period we are in AI?
Well, I think I think of AI. Hey, we may have finished the national anthem, but we're still best case in the first inning. We just have lots of innovation in front of us yet. Our chips are too power hungry. The models are, finding limitations of large language models. We need new knowledge representations, for them. Every application needs to become AI infused. We're just at the beginning, and that's before we even get to some of the really exciting stuff like quantum computing. So this is going to be the greatest couple of decades for technologists. And obviously for OpenAI, they've been in an unquestioned leadership position in models. All of a sudden, what Google and Gemini and now, with their, TPUs coming to market, hey, Google is roaring back. Competition is a great thing. And we need more cost-effective AI. So some of these chip alternatives, we're working on new chip companies at Playground, that will be not a little bit better, but 10 or 100x better than today's chips. And of course, that's before we get to new models of computation like quantum. This is a great time to be a technologist.
Pat, you make a heck of a point there that Google is renewed. I mean, the reviews in that new model, mind-blowing. If they're renewed, if 2026 is going to be the year of Google, what does that mean to an OpenAI's future? And do you share the concerns about circular financing? I mean, OpenAI is at the center of so many deals.
So, hey, competition is good. And, I think, quote, Sam's comments were waking up his organization. We cannot presume leadership is given to us. We have to earn it every day. So I think that's good for OpenAI, good for Sam. But there's also other players, obviously Anthropic, Amazon, Microsoft, et cetera. They all need that same sense of urgency. And we have several great startups that we're working on in this area. Circular financing to me, hey, big balance sheets, using those balance sheets in a creative way, no problem with it. But the quality of that revenue that they're committing in the future simply isn't as good, right? Because essentially I'm buying my own future revenue. That's like saying, I have higher credit risk, because rather than you putting your capital at risk, I'm putting my capital at risk. So I think in that regard, you just say it's just not as good as if somebody else were committing that revenue. But I don't think it's a fundamental issue in any way. These are healthy companies with healthy balance sheets. Ultimately, we're not going to get too far ahead of ourselves because we're fundamentally limited by power availability. As I've said, we're not capital limited in AI. We're energy committed in AI. We must build our energy grid more rapidly.
Pat, before I let you go, you of course led the charge to at Intel for making its own chips. Now, some people gave you a lot of guff for that, but now it looks like Apple may be using Intel to make chips. What say you?
Oh, I'm thrilled. If that's the case, I'm thrilled because, this agenda that, we need to have Intel as a foundry, for the industry, super important, priority for me. And I'm happy to see the current team continuing that. And whether that's Apple, NVIDIA, Qualcomm, AMD, all of them need to be building in Intel factories for the future. They need to be building more in the U.S. And if this comes to pass, that's just the beginning. Many more need to do likewise, and happy to see this progress.
It's still wild for me, Pat, to see NVIDIA invested in Intel. I can't wrap my head around it. Can you wrap your head around it?
Absolutely. We were well underway in those discussions when I was there, and happy to see that come across the line. And obviously, I wish nothing but the best for Intel, for Lipton, grateful for the time I had there. But hey, I'm in a good place now.
Taking a look at some stocks here, moving after hours. Shares of Snowflake moving lower. Company beating third quarter earnings estimates and announcing a partnership with Anthropic, but a weak profit margin outlook weighing on the stock. Company expanded partnership with Anthropic worth $200 million to bring Claude models to Snowflake's Cortex AI. On earnings, the company reporting Q3 revenue of $1.21 billion. That beat analyst estimates. Adjusted EPS also beating estimates and coming in at 35 cents per share. Shares of Five Below rising after the company raised its full-year outlook again. It's a third increase in the current fiscal year. The retailer has benefited from a more cost-conscious consumer. Same-store sales jumped 14% in the third quarter. That was double the analyst estimates. And UiPath shares jumping after reporting a beat on revenue for the third quarter. The automation platform reporting a year-over-year 11% increase for its annualized renewal run rate. The CEO highlighting momentum as customers scale agentic automation across the enterprise. Looking ahead to the fourth quarter, the company is expecting revenue in the range of $462 to $467 million. Time now for what to watch Thursday, December 4th. Starting off on the earnings front, we're getting a big batch of reports on Thursday from the retail sector, including Kroger, Dollar General, and Ulta Beauty. Kroger announcing results for the third quarter in the morning. Analysts expecting Kroger to take a big accounting hit in Q3, about $2.6 billion, because it's shutting down 3 of its automated fulfillment centers. Moving over to the Federal Reserve, more commentary coming on Thursday from Fed Vice Chair for Supervision, Michelle Bowman. This is coming ahead of the Fed's preferred inflation gauge, PCE, coming out on Friday, and the December FOMC meeting coming out next week. Investors will listen closely for any clues in the new commentary for the Fed's path on monetary policy. And taking a look at the labor market, we'll be getting weekly initial jobless claims data on Thursday. Economists forecasting that number to tick up to 220,000, signaling a small bump in claims, but still historically low. And that's a wrap on Today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet.